From poverty and war-torn Guangdong to commanding ports, telecoms, and utilities across continents, the Li dynasty rose by mastering fear, contracts, and concessions. In this video, we expose how Li Ka-shing built an empire from plastic flowers to Hutchison Whampoa, and how his heirs turned it into a machine of global infrastructure. This is Family 11, the Li dynasty, the eastern coil of the snake, embedding control into finance, technology, and daily life itself. Dynasty 11, the Li family, masters of Eastern finance and global infrastructure origins, ascent and empire building 1928 to 1949, poverty, war, and the discipline that forged a dynasty. Li Ka-shing was born in 1928 in Kaiyuju, Guangdong, into a modest family with a schoolteacher father and a mother who ran the household with strict thrift. The 1937 expansion of the Second Sino-Japanese War shattered daily life across Guangdong, culminating in repeated displacements. In 1940, as Japanese forces threatened the region, the family fled to British-ruled Hong Kong with little more than clothes and a few personal effects. In 1943, tuberculosis took his father, forcing the 15-year-old Li into adult responsibility and long shifts in a plastics factory. He moved rapidly from worker to line foreman, learning the language of cost, throughput, defect control, procurement, and export schedules. Those years embedded 3 lifelong habits: relentless cost discipline, opportunistic timing, and an obsession with cash reserves. The dynasty begins here, not in a boardroom, but in survival calculus. 1950 to 1966, Cheung Kong Plastics and the First Fortune. In 1950, at 22, Li Ka-shing founded Cheung Kong Plastics. He financed early tooling through loans and vendor credit, purchased second-hand injection machines, and targeted one of the fastest-growing post-war niches: plastic flowers for export to North America. Hong Kong's low wages, access to shipping, and British legal framework made it the ideal export platform. By the mid-1950s, Cheung Kong's unit economics were lethal. Rapid cycle times, tight scrap rates, ruthless vendor negotiation, and a relentless push into higher margin designs. By 1957 to 1959, the factory was one of Asia's largest producers in its category, with export contracts denominated in hard currency that created durable reserves. Li learned to anchor cash flows to international demand and hedge local instability with dollars and sterling. He built distribution relationships that later became intelligence channels: who was buying, where margins were moving, which retailers were expanding. The First Fortune was not luck. It was the precise orchestration of production, shipping, and contracts under British commercial law. 1960 to 1971, the real estate pivot and balance sheet power. In the early 1960s, Li started reinvesting profits into land and buildings, beginning with industrial properties aligned to his factory operations, and then graduating to residential and commercial plots. Crucially, he studied British lease structures, zoning rules, and banking practices in Hong Kong, building a balance sheet engine that could multiply returns beyond manufacturing. In 1967, political turmoil and leftist riots shook Hong Kong. British firms and nervous landlords sought to reduce exposure, shedding assets. Li stepped in as a buyer of last resort, deploying cash reserves and friendly credit lines to acquire properties at depressed prices. This was the pattern he would repeat for decades: buy into fear, exit into stability. By 1969-1971, Cheung Kong Holdings had consolidated prime land positions and construction projects that converted post-riot fear into multi-year revenue streams. The plastics factory still minted cash, but real estate anchored to legal title and long-term rental contracts became the dynasty's second spine. 1972 to 1979. From manufacturer to conglomerate, positioning for the takeover. 1970s were about infrastructure proximity. Li expanded Cheung Kong's construction arms, deepened banking relationships, and cultivated boardroom ties with British corporates and Hong Kong elites. He watched one asset in particular, Hutchison Whampoa, a colonial trading house founded in 1866 with tentacles in shipping, ports, warehousing, insurance, and utilities. Hutchison had heritage, assets, and global reach, but also complexity, legacy costs, and a post-imperial identity crisis. By 1977-1978, Li had the capital stack, the advisors, and the political calibration to make a historic move. HSBC, which had significant influence over Hutchison, wanted stability and credible local ownership. Li offered exactly that, with a track record of disciplined operations and an understanding that the future of Hong Kong would require Chinese leadership with global fluency. In 1979, he acquired control of Hutchison Whampoa, becoming the first Chinese businessman to take a major British conglomerate. This was not just a transaction. It was a transfer of imperial infrastructure into dynastic hands. 1,989 ports, energy, listings, and global reach. Ports. In 1981, Li formalized Hutchison Ports Holdings, systematizing container terminal investments and operations across Asia, Europe, and the Americas. He targeted concessions, long-term leases, and BT, build, operate, transfer, models, building recurring cash flows anchored to global trade rather than local politics. Ports are contracts and cranes. He mastered both. Energy. In 1984, he bought into Husky Energy in Canada, diversifying into upstream oil and gas. This move strengthened dollar-denominated dividends and hedged against local shocks. Capital markets. In 1986, Cheung Kong Holdings listed in Hong Kong, transforming private cash discipline into public market muscle. The listing multiplied his firepower for acquisitions and development, while disclosures built credibility with international investors. Finance and insurance. Through Hutchison and parallel vehicles, Li expanded holdings in finance and insurance, positioning the group as a diversified conglomerate with risk spread across infrastructure, property, energy, and services. By the late 1980s, the Li footprint touched ships, ports, pipelines, towers, shopping streets, and bank ledgers. He was not a businessman in the narrow sense. He was becoming a sovereign infrastructure operator. 1990 to 1999. Telecoms, retail scale, and technology bets. Telecoms, UK and Europe. In 1993, Li backed Orange in the UK, demonstrating an early instinct for wireless assets. He later exited profitably, proving his build early, sell into optimism rhythm. By 1999, he launched 3 across Europe and Asia, betting on 3G licenses and the long runway of data services. He took regulatory complexity spectrum auctions, license conditions, capex, and turned it into scale economics. Retail, S. Watson Group. Throughout the 1990s, he expanded S. Watson Group into a multi-continental retail and health beauty chain, including Watsons, Superdrug, and Fortress. Retail gave him two assets beyond sales: bargaining power with suppliers and a data lake on consumer behavior. Real estate cycles. He continued the classic Li playbook: acquire in down cycles, build during stabilization, and recycle assets during exuberance, locking in capital gains while retaining operational anchors. By 1999, the empire had three massive flywheels: ports, trade, telecoms, communication, retail, daily life. Each reinforced the others. A container through his terminal might carry goods for his stores. A customer in his shop used his mobile network. Dividends from energy-financed capex and telephony and cranes. 1997 to 2003. The Hong Kong handover and crisis navigation in 1997. Sovereignty shifted from the UK to China. Li's diplomacy was clinical. Keep British boardroom ties alive while cultivating Beijing relationships through advisory roles, charitable foundations, and visible reinvestment in Hong Kong. In 1998, Asian financial crisis and early 2000s tech volatility tested balance sheets. Li cut where returns weakened, leaned into assets with long concessions, and protected liquidity. He understood that ports with 20 to 30-year concessions and regulated utilities beat hot narratives when markets turn cold. 2004-2010. Infrastructure dominance and European penetration. From 2004 onward, Hutchison Ports consolidated its position as one of the largest port operators globally. At the same time, CKI, Chiang Kong Infrastructure, expanded into European regulated assets, UK water and energy distribution, stakes in water companies, electricity distribution, gas pipelines assets with regulated returns, inflation linkage, and political sensitivity that Lay navigated with understatement. Transportation concessions, toll roads and related infrastructure delivered long-tail cash flows insulated from daily market drama. By 2010, the Li ecosystem controlled or influenced terminals moving a significant share of the world's containers, utilities delivering water and energy to millions of homes, phone networks in multiple countries, and retail chains embedded across 30 markets. He didn't just enter sectors. He bought the arteries of modern life. 2011 to 2015. Structural consolidation and capex discipline. The 2010s were about strengthening and tidying the empire. Telecom rationalization. Pursuit of mergers and network sharing in Europe to stabilize margins and scale. Asset recycling. Strategic sales of mature assets to redeploy capital into higher growth or higher certainty projects. Group simplification and reorganization, moving toward a clearer split between property development, later CK Asset, and diversified infrastructure, telecom, retail under CK Hutchison, improving transparency and valuation. This period refined the dynasty's financial architecture, fewer silos, clearer investor narratives, and sharpened control over capex and returns. 2016 to 2018. Formal succession, continuity, and new leadership. In 2018, Li Ka-shing retired from day-to-day leadership, handing the reins of CK Hutchison to his elder son, Victor Lee Sar-Kui, and leaving Richard Lai to continue building out Pacific Century Group, finance, insurance, media, telecom ventures, including regional plays. Succession was the ultimate test. Would the machine run without the founder's presence? The answer was yes, because the machine had been designed as an institution, not a personality cult. Contracts, concessions, spectrum licenses, board seats, and regulatory relationships do not retire. They roll forward. 2019 to 2023. Dynasty in a world of shocks, trade wars, regulatory shifts, pandemic disruption all tested the resilience of owned infrastructure. Ports navigated throughput volatility, but kept concession clocks ticking. Telecom saw data demand surge. Retail flexed supply chains and e-commerce pivots. Utilities maintained regulated cash flows. The dynasty's design-own assets. People cannot live without proved itself again. In parallel, family office activities and Hong Kong's push to attract global wealth intersected, formalizing the Li presence as a permanent financial institution beyond listed entities. How they actually arrived in power. The mechanics behind the dates. Cash in fear. 1967 riots enabled discounted property accumulation. Repeatable pattern. Buy into distress, hold through stabilization, monetize into optimism. Acquire the choke points. 1979's Hutchison takeover captured ports, shipping, and services. Choke points produce persistent cash and leverage across jurisdictions. Diversify into regulated certainties. Energy and utilities amortize risk. Port concessions and telecom licenses bake in time-bound exclusivities. Exploit cycles with discipline. Enter early, exit into exuberance, never overpay for narrative. Listings and asset sales fund the next wave. Institutional diplomacy. Maintain credibility with colonial and communist power centers simultaneously. The handover did not break him because his assets served both regimes' needs: stability, employment, predictable returns. What made the ascent undeniable? Cross-sector control, ports, trade, telecoms, communication, retail, consumption, utilities, life support, real estate, space. Few families link all five at scale. Contractual sovereignty. Concession agreements, spectrum licenses, long-dated leases, regulated return frameworks paper that outranks headlines. Crisis immunity design. Assets chosen for necessity, not fashion. Cranes turn even in recession. People still need water, energy, phones, and basic goods. Global jurisdiction spread. Asia, Europe, Americas. No single regulator could unplug the dynasty. Risk was distributed, but cash consolidated. Direct impact on daily life. And why this is power, not celebrity. Your goods. A meaningful share of what people buy passes through terminals they operate. Your phone. Millions connect via networks they own or control. Your home. Water and energy distribution in multiple countries runs through their pipes and wires. Your street. Retail chains sell essentials in thousands of outlets. Your rent and mortgage. Property cycles in Hong Kong and beyond were shaped by projects they financed and delivered. The Li ascent is not business success in the ordinary sense. It is a rewiring of modern life around assets that pay them regardless of the mood of markets. They arrived in power by mastering the timing of fear and the law of concessions. Rank 11. Placement logic for the dynasty. Regional anchor. Global reach. They dominate Asia's infrastructure and extend control into Europe and the Americas. That reach is real, but not absolute domination of global finance. Hence rank 11. Asset sovereignty versus money sovereignty. They own the arteries, ports, utilities, telecoms, while families above them own the monetary plumbing, global banks, reserve currency influence. The Li dynasty is indispensable to the flow of goods and services, which is why rank 11 is high and stable. Bridge between systems. Fluent with British law and Chinese state priorities, they are a living conduit between East and West, profiting from both, controlled by neither. Dynasty 11. The Li family. Modern control, seats of power, and the machinery behind rank 11. Control stack in 2025. The living architecture of a dynasty. The Li family's power today is a layered machine built around listed groups, private vehicles, concessions, and board-level interfaces that fuse hard assets with political reach. At the top sits C.K. Hutchison Holdings, chaired by Victor Li Tsar Kui, alongside C.K. Asset and C.K. Infrastructure. Richard Li operates Pacific Century Group in parallel. This division of labor stabilizes the dynasty across property, infrastructure, telecoms, retail, and finance, with Victor's roles confirmed across C.K. Hutchison, C.K. Asset, and C.K. Infrastructure, and his public profile as a bridge between capital and policy forums in Hong Kong. The family's ongoing institutionalization of its family office in Hong Kong formalizes private capital flows and embeds them in the city's wealth hub agenda, setting a permanent governance spine for dynastic decision-making beyond the listed vehicles. Their institutional footprint is measurable. C.K. Hutchison publishes detailed segment analyses, capital calendars, and risk factors across annual reports, mapping operating decisions to geographies and regulators. Those disclosures show disciplined asset recycling, region-specific operating performance, and concentration in essential services, utilities, telecoms, health, beauty, retail, where demand persists regardless of market mood. On balance sheet strength, independent trackers record total assets around the mid-$140 billion range in recent years, signaling durable scale across cycles. Telecom power, spectrum, towers, and multi-jurisdiction cash flows. C.K. Hutchison's telecom arm, 3 Group Europe and other holdings, gives the Li family control over licensed spectrum, nationwide networks, and millions of customer relationships across multiple jurisdictions. This is not mere retail telephony. It is a regulated monopoly adjacent asset backed by spectrum rights and massive sunk capex in radio access networks and backhaul. The model is simple and potent. Spread capex across markets. Squeeze OpEx through network sharing and IT consolidation. Harvest scale on customer data and roaming, and lobby for consolidation to stabilize margins. Investor materials and operations analysis from C.K. Hutchison document the segment's performance, capex cycles, and regulatory risks, underscoring how spectrum licenses lock competitors out and keep cash flows predictable within policy bounds. Victor Li's strategic focus on infrastructure and telecom, a shift from founder-era opportunism into structured, regulator-managed returns, keeps the dynasty moored to assets that governments need to function. His public roles and profiles reinforce the dynasty's position as a reliable operator in sectors where policy trust and boardroom stability matter as much as P and L. The telecom stack functions as the dynasty's modern choke point, licenses, towers, and switching nodes that few can replace without state consent. Retail command, S. Watson Group, and everyday reach. Where telecoms capture communication flows, the A.S. Watson Group captures daily spend and brand stickiness. Through chains like Watson's, Superdrug, and Fortress, the conglomerate sells health, beauty, and household essentials at scale. Segment reports show revenues in the hundreds of billions of Hong Kong dollars, with strong EBITDA that is unusually resilient because it tracks mass-market staples rather than luxury cycles. This positioning gives the dynasty bargaining power with suppliers, rich data on consumer behavior, and a distribution backbone that can pivot quickly in shocks, pandemics, supply chain dislocations. The governance story matters. Retail performance is reported with enough granularity to reassure investors while retaining commercial secrecy. And it sits inside a cross-segment machine that can cross-subsidize capex, telecoms, or absorb volatility, ports, when they own them, without losing the war. It is structurally unglamorous, strategically lethal. Daily life pays them every day. Ports and logistics, reweighting the empire under geopolitical pressure for decades. Hutchison Ports was the dynasty's flagship in trade flows, concessions, and terminals across continents. In 2025, C.K. Hutchison executed a decisive pivot, offloading global ports operations outside China to a consortium led by BlackRock in a $19 billion cash deal. Public reporting ties the sale to geopolitics, including scrutiny around Panama Canal operations and pressure over Chinese-linked supply chains in strategic waterways. The sale reduced profit in 2024, but banked liquidity at scale, restructuring risk away from flashpoints while retaining core operations and China-linked terminals. Analysis from sector outlets points to a reality the Li dynasty confronted directly. Ports became hostage to nation-state rivalry. If you cannot de-risk Panama, Mediterranean transshipment, or Atlantic choke points without political blowback, you take the money, rotate into assets where governments invite you to stay, and redeploy into areas with clearer regulator-based returns. That move fits the dynasty's 50-year pattern. Buy into fear, exit into hostility, reweight into necessity. It is not retreat, it is precision maneuver. Utilities and infrastructure. Regulated returns as a dynasty engine. CK. Infrastructure and allied entities hold stakes in water companies, electricity distribution, gas pipelines, and transport concessions. Utilities are mathematics, regulated asset bases, inflation linkages, determinations of allowed returns, and capex reviews. C.K. Hutchison's operations analyses describe this world in neutral prose: segment revenues, margin behavior, sensitivity to regulator decisions, and jurisdiction breakdowns. Beneath the prose sits a dynasty logic: assets that must exist, must be maintained, and pay fairly predictable yields over long horizons. This is the dynasty's second spine after telecoms: conduits for water and energy, wires and pipes that keep cities alive. Regulated utilities are not immune to politics, but they tend to be insulated by statutory frameworks that prefer credible operators over ideological experiments. The Li dynasty excels in this terrain because it offers quiet competence and balance sheet strength. When crises come, utilities do not disappear. They adjust prices, scale maintenance, and keep paying. That is why CKI has become the ballast of the group, smoothing earnings even when other segments face geopolitical friction. Banking and the old city seats. Management control without majority ownership. Long before telecom towers and retail aisles, the dynasty cultivated seats in banking that conferred influence disproportionate to equity. The Li banking family is historically associated with the Bank of East Asia, a Hong Kong institution founded in 1918 with complex holding structures that allowed the Li clan to retain direct management control despite a minority stake. That pattern, control via board seats, family networks, and layered shareholding, has persisted across generations, with members touching not only the bank, but public institutions across government, judiciary, and legislature over time. This minority control tradition is a hallmark of oligarchic Hong Kong finance. Families steward institutions through directors and alliances rather than blunt majority ownership. It protects continuity, complicates hostile moves, and ensures the dynasty's voice is embedded in the city's credit bloodstream. Paired with C.K. Hutchison's disclosures and the family office institutionalization announced for Hong Kong, the dynasty's banking reach is less about vanity and more about quiet leverage over liquidity, formal credit, and public signaling when shocks hit. Political interfaces. How the dynasty secures consent. No oligarchic machine survives without state consent. The Li family's post-founder governance places Victor Li visibly across business councils and policy adjacencies, including membership in forums like the Chinese People's Political Consultative Conference, which functions as a high-level advisory and consensus channel for state priorities. This presence is not ceremonial. It reassures regulators that the dynasty will operate as a compliant steward of critical assets and invest in ways that align with national targets. Digital infrastructure, logistics modernization, healthcare retail, and green transitions. In Hong Kong, the Li clan remains one of the big four business families shaping the city as economic architecture, a shorthand for dynastic power across property, retail, telecoms, and finance that policymakers cannot ignore. Profiles of the Big Four situate the Li family's empire firmly inside the city as governing oligarchy, anchoring policy dialogues and cementing their negotiating position when regulatory lines move. This is how the dynasty keeps its licenses, secures its concessions, and gets early visibility into rules before they become headlines. Modern risk posture. How they manage shocks without losing the machine. The last half-decade tested every dynasty. US-China fracture, sanctions creep, supply chain fragility, and populist pressure against perceived monopolies. C.K. Hutchison has annual reports, and operations analyses document how the group managed these shocks, selling exposed assets, ports outside China to reduce geopolitical crossfire, defending telecom margins via operational consolidation, and leaning on utilities and retail to stabilize earnings. Revenues remain massive, hundreds of billions of Hong Kong but reported earnings fell in 2024 as asset sales and reweighting flowed through the statements. Macro trends data show a plateauing in total assets since 2021, consistent with strategic de-risking rather than sudden expansion. That tells you the dynasty chose survival over glory. Bank the cash, lower the temperature, stay essential. The family office move in Hong Kong complements this. Formalize private capital, pivot fast across vehicles when policy tightens, and keep the listed groups clean and credible for global investors. Seats of power today, where the dynasty actually sits board chairs and managing directors across CK Hutchison, CK Asset, CK Infrastructure. Victor Li's mandates root the dynasty at the apex of decision-making for assets that households cannot live without. Telecom licenses and nationwide mobile networks. 3 Group Europe and related holdings. The state-granted backbone of communication and data flows, defended by regulatory relationships and published risk frameworks. Health beauty retail across continents via A.S. Watson. Mass market distribution, supplier leverage, and consumer data at multi-billion HKD scale. Regulated utilities, water, electricity, gas, toll roads. Predictable returns in jurisdiction, specific regulatory consent, documented in operations analyses and investor reports. Banking and city institutions via B-linked lineage, minority control mechanisms and generational management embeds the family is influence in credit and public decision networks. Family office headquarters in Hong Kong, institutionalized private capital that outlives quarterly reporting and locks the dynasty into the city as sovereign wealth ambitions. Oligarchic standing among Hong Kong's Big Four, policy adjacency and social license to operate across sectors, uniting business leverage with political pragmatism. Each seat is a lever. Together, they form a structure that turns legislation and infrastructure into continuous cash and influence. Why rank 11? Neither myth nor monopoly, but indispensable. Rank 11 is not vanity. It is placement logic. Families above the Li dynasty exert power over reserve currencies, global banking cartels, and supranational institutions. The Li family controls the arteries that make those money systems relevant, ports, until 2025's reweighting, telecoms, utilities, retail, across multiple jurisdictions. They bridge British commercial law and Chinese state priorities, making them both a conduit and a counterweight. Their risk posture since 2021, asset rebalancing, earnings volatility, asset-based stability, reflects the cost of being indispensable in a world that punishes exposed choke points. They are not emperors of finance. They are engineers of the modern city. Tactical counter-ritual, levers the public can actually pull against a living dynasty. Force radical transparency in telecom consolidation, publish spectrum transfers, network sharing agreements, and consumer price impacts in plain text. Demand regulated utilities disclose real return calculations and capex justifications line by line, attach public audit rights to determinations. Require retail chains to publish supplier concentration and pricing strategies for essential goods to expose margin extraction. Mandate board-level conflict registers that include family office cross-holdings and LP stakes, not just listed shares. Subject family office vehicles to beneficial ownership registries with enforcement teeth. Align Hong Kong wealth hub policies with anti-opacity norms. Tie concession renewals, ports, toll roads, to public performance dashboards, throughput, accidents, pricing, under independent auditors. These moves attack opacity where the dynasty depends on it. Regulated consent, licensed rights, and data shadows around consumer pricing. Direct answer: the Li family's modern power sits in board chairs, concessions, licenses, and regulated returns. It is documented in C.K. Hutchison's reports, reinforced by Victor Li's roles, anchored by S. Watson's retail scale, secured by utilities, and historically extended by minority-controlled banking seats. In 2025, they re-weighted away from geopolitically exposed ports outside China, taking $19 billion cash and focusing the machine on assets governments invite them to keep. That is how an indispensable dynasty survives shocks and keeps its rank. Wake TF Up. You've been watching Wake TF Up, Sovereign Signal, where we tear down the fog and expose the dynasties that shape our world. We've just revealed the Li family, masters of Eastern finance and infrastructure. Next, we move to Family 10, the Onassis bloodline, who turned the oceans themselves into instruments of control. Stay with the signal. Like, share, and subscribe, and hit the notification bell so you never miss the next strike in this sovereign awakening.